I'm Jared Dillian. This is Peter Atwater. We're here for the collective. We are going to have a conversation about sentiment and confidence and all kinds of cool stuff.
It's the stuff we spend our day thinking about.
I know. We talk to each other a little bit over email and Twitter, and we're usually on this. We actually haven't talked in a while, but the first thing I want to talk about, you see, usually you're at a turning point when everybody is fighting about something.
Mm-hmm.
Okay, so when everybody was fighting about Bitcoin in 2021, that was the top. When everybody was fighting about stocks last October, that was the bottom. What is everybody fighting about right now?
Right now, it's funny. They're obviously fighting about bonds.
Yep.
But to me, that still feels more like a tug of war than it does what I think of as the classic one-sided, you're an idiot if you don't agree with me positioning that we see at extremes.
Mm-hmm.
But what's so interesting to me about where we are right now, and this is, the middle part of November, is you've got mood that is low enough to mark another low in terms of the markets broadly and bonds particularly, but not all of the signs that I would have expected to see with that. And I know you're on the other side of that. You've been very clear about the enthusiasm in bonds in being short bonds.
Well, I mean, there's the other thing I want to add about people fighting about stuff all the time is that usually you get to the end of a trade when there's a cult around
Mm-hmm.
the trade, right?
Yeah.
And I think that there is a cult around short bonds, not as intense as Bitcoin or stocks, but it is developing. There's a hashtag. There's a hashtag for this trade. It's called H4L, higher for longer.
Yep.
And this is, I don't know if I should name names, but there's some Bridgewater guys on Twitter that have been really vocal about this trade, and they've attracted a lot of followers, and they're hashtagging like H4L, higher for longer. And there's this belief that interest rates are just going to keep going up and up and up. And the other thing is that people are always attracted to the doomsday trade.
Yes.
You know what I mean? So
particularly on social media.
On social media, yeah. So just as stocks in last October was the doomsday trade, this is kind of the doomsday trade, because if tens go to 6, 7, 8%, like the world blows up,
Yep.
like we're insolvent, and that's so. And the markets usually pull back from that doomsday scenario. So
yeah, the doomsday scenario feels very present. And I think that as an investor right now, you have this weird dynamic of betting on a highly unlikely event, which would be bad goes to really worse.
Yep.
Or betting that it's bad enough and the rebound comes. And so I've sort of been of the view, plan for what you can imagine, which to me is that the markets rebound here, but be prepared if they don't.
You say with the bond market rebounds.
If the bond market.
Yeah.
And I talk about everything sort of conjoined, because in terms of sentiment, at least since early 2021, stocks, bonds, and currencies have been all one mood trade.
Mm-hmm.
It's this thruple of conjoined ups and downs, and so the concern that I have is if bad goes to worse, it becomes in everything at the same time. So you have this self-feeding mechanism where bonds go up, stocks go down, currencies, the dollar strengthens, creating unexpected consequences, particularly in a place like Japan.
This is this isn't really a sentiment issue, but I guess it kind of is. But talking about the central bank, talking about the Fed, the central bankers themselves are usually the last to know that they're going to pivot.
Mm-hmm.
Like they're always the last to know. We got some comments out of Christine Lagarde this morning that she doesn't see the ECB cutting for several quarters, which is super interesting. You've heard all this talk about Fed officials, about how they're, look, like the longest that the Fed has ever been able to maintain rates at a peak after a hiking cycle is 7 months. Only 7 months, and that was in 2007. They always start cutting because they overdo it on the way up.
Yep.
And they always start cutting. If you look at a chart of Fed funds over time, over like 50 years, you see on these hiking cycles there are spikes. That you don't see interest rates go up and then stay flat for 2 years. They're always spikes and they come down. So
yeah, and I think the Fed being a bureaucratic government body is always going to be a lagging indicator.
Yep.
I mean, I chuckle when people talk about the markets following the Fed, and to me that's really quite laughable because groups of people move far more spontaneously than committees, and you end up in this environment where you have the crowd watching this lagging indicator, expecting it to
Yep.
be leading us, and it's just not the case.
yeah, I mean, Cash Carey in particular, sort of an interesting guy. But he's still talking about rate hikes. I mean, a lot of people have complete amnesia about the fact that he was the last one to pivot before the rate hike started. He was still talking about keeping rates at zero when the rest of the Fed had pivoted. So, he's kind of the dummy, and I think that's a pretty good indicator. So,
You have this sort of cast of characters that you can watch.
yeah, I mean, I personally have a position in 2-year notes that I've been cheerleading for the last 3 months. I've been averaging into it over time.
Yep.
Starting about 3 months ago, and it's quite large at this point. And the way I look at this trade is that there's huge amounts of asymmetry. The Fed has more or less said that they're done hiking rates, and the data is terrible. And unless the data just got extraordinarily hot at some point in the near future, they're probably not going to hike rates again. So your downside is capped. And if they cut rates, they're probably not going to cut 25 or 50 basis points. They're probably going to cut 200 or 300 basis points. So there's huge amounts of asymmetry in that trade, and that's why I like it. It's very cheap optionality. And the other thing about trading short-term rates, which, look, I've been doing this since 2001. Since I was trading index arb at Lehman. Index arb is a short-term rates trade. So I've been reading Fed speeches and trading Fed fund futures since I was like 27 years old. The really easy thing about trading short-term rates is that they trend. Without a lot of volatility, they trend in one direction, which makes it very difficult to get shaken out of a trade once you're in it.
Yeah, and I think that given the shape of the curve, that's a pretty safe bet. Even if we do start to see rates rise, I mean, your give back in terms of value isn't going to be all that much.
Yeah, it does. It does cause me some stress, though.
Yep.
It does cause me a little bit of stress.
So one of the other things, since we're talking about central banks, that I got asked a couple of years ago, is there a sentiment measure for central banks? And my knee-jerk reaction is, yeah, interest rates themselves. If we go back to the early 1980s, the crowd's view of central banks was damning. They were incapable, incompetent. The terminology that we use.
Basically, the opposite of omniscient.
Exactly.
But in the 90s, we had Greenspan, who was omniscient, and
Yeah.
we trusted central banks.
And you've had, don't fight the Fed. There's no alternative. I mean, that sort of sense of invulnerability, invincibility, and it's been interesting. It's subtle, but you've seen people beginning to challenge the credibility of the Fed as interest rates have risen. And I think one of the risks in this environment of rising rates is that the higher rates go, the less confidence people will have in central banks and policymakers more broadly to be able to do something in response.
The way I look at the Fed, which you might have read in my newsletter at various points along the way, is that since they are a government institution, they always follow the path of least embarrassment, or they try to follow the path of least embarrassment. Like the Fed has a P&L, and at the moment they're losing money because they have this giant balance sheet and rates went up and stuff like that, but they don't care that they're losing money. Like that's irrelevant to what they do. What they care about is their reputation and saving face. And the way you have to think about the Fed is what would hurt the Fed's reputation the most? Would it be tightening too much or tightening too little? And it would actually be tightening too little, because if inflation continued higher, and that would cause all kinds of political problems for Biden and everybody else. So that's why up until this point, they've had a bias to hike more than was necessary. But at some point, that dynamic is going to shift and the economy is going to get weaker and unemployment's going to go up. And then they're going to be faced with a different problem. And they're like, the path of least embarrassment is going to dictate that they're going to have to do something about a slowing economy. Right? So if you're trading rates, really what you try to identify is that inflection point in the Fed's, not mandate, but I guess their outlook on, what do they care about the most? Which reputation are they trying to protect,
So this morning we've got new consumer sentiment information and a sense that, inflation expectations, rather than coming down, have gone back up. Do you think that has any impact on the Fed's urgency to cut or lack thereof?
I do think so. Bonds sold off on that news. And it's funny because the sentiment data itself was terrible. Huge misses in consumer confidence. But it was the inflation expectations that caused the bond market to go down. I think they do care about that. I still think the possibility of them hiking rates is remote, but probably makes them less likely to cut in the short term for sure.
I just think that they're still fighting the ghost of 1970s past, where they're afraid of inflation expectations getting grounded at a higher level than they would like.
Yeah, and you probably saw those comments from Ken Griffin the other day about how he thinks high inflation is going to be here for decades and stuff like that. Like, whenever I see stuff like that, I look at the Trueflation numbers, which are about 2.3%. So if their target, however stupid that is 2%, we're actually pretty close to the target. And I think it's possible we could be looking at a disinflationary environment pretty soon. It brings me what I want to talk about with my house.
I was about to say, let's talk about housing.
So I just listed my house for sale about 3.5 weeks ago. I listed it at X, and we had 3 showings, and we got some feedback that the price was too high, so we listed it at 0.9X. But this is really the interesting part. So I live in a neighborhood of about 200 houses on the beach in South Carolina, okay? And it's a reasonably high-end neighborhood. And up until September, houses were selling in 2 days, and they were selling through the offer. It was a very hot housing market. And you know what changed everything? October 7th. October 7th, the attacks in Israel, and all the housing market turned on a dime. And everybody withdrew. You like to talk about confidence. The confidence disappeared. Like, that one event changed the entire mood on the housing market. So, my neighborhood is kind of a microcosm of the whole country, but I've also read some articles recently how this phenomenon has happened nationwide. Like, the housing market, since that time period around October 7th, like, bids have disappeared and prices are starting to come down.
And at the high end, it's essentially been a cash market where, what's been moving houses at the top isn't interest rates as much as it's been market prices broadly, because, nobody's at the high end, folks aren't going to take out a 7-8% mortgage if they've got the ability to move out of one house into the next.
Yep.
And so I think it's indicative of high-end confidence that is now...
I've heard a lot about this, the rich session. Mm-hmm. Yeah. What do you have to say about this?
So I use LVMH
Yep.
as my how are the rich feeling barometer. Because I think it's a stock that not only caters to the rich, but is largely owned by the rich. So it's a funny... the clients or the owners are, it's a
ecosystem.
Yeah.
Yeah.
And it's been fascinating to watch that it's pulling back. The art market is doing the same. And so I think you are starting to see that happen. And I don't think people appreciate how overbuilt the luxury world is broadly in its capacity to deliver to this very small universe of people.
So when you say the luxury world, you mean like, Prada and LMVH and all these luxury brands and housing and
hotels
vacations and hotels
and travel broadly is that the mindset has been as long as we're making money at the front of the bus, it doesn't matter the price in the back of the bus. And I think that's indicative of a business model today that's more fragile than people realize. There's a sense that the wealthy will always be insulated.
Well, wasn't there this old trading rule that like when Sotheby's and Christie's rolled over, that's when the recession was coming? Like it was a pretty good leading indicator.
Yeah.
Yeah.
And I just think LVMH is a great proxy for global enormous wealth today, and that would pick up even things like political dynasties in countries, because they're the clients of Lamborghini and Ferrari and all of these high-end luxury good makers.
Well, Bitcoin is coming back. Maybe that'll change.
And Bitcoin is coming back. Yeah, the front running of crypto to me is a really fun thing to watch. The certainty that the crowd has that we're going to have ETFs and that's going to reopen the world. And I can't help but wonder if the ETF is actually the sell signal.
Probably when the ETF gets launched.
Sell
well,
the
it
news.
was when the futures ETF was launched.
Mm-hmm.
Like, if you remember, that was like a local top.
Yeah.
Yeah.
So I mean, the crypto crowd is back, and you've even seen now legislation that Congress wants to penalize the SEC, get them out of the picture.
Yeah. I mean, I got into this. Actually, I got into a sort of an argument with Raul.
Oh.
Because I tweeted that I'm like, how is the launch of a crypto ETF good for Coinbase at all? Right? Like that they get X% of their revenues from commissions, and the commissions are large.
Yep.
Like if somebody can trade commission free on Robinhood on a spot Bitcoin ETF that has a 10 basis point expense ratio, like how is that good for Coinbase? And he was trying to explain to me it's the custody business. They're the custodian for all this Bitcoin, and I'm like, that's a very slow, boring business. Like that doesn't seem like.
But I think that's a great example of just the storification that goes on when these phenomenons happen. That it's put Bitcoin in your name, and you too will see your stock rise in the midst of it. And I think that's. We're seeing a lot of that collective behavior where things are moving as one based on the pack where the crowd is moving.
I have a portfolio of altcoins that I've had for a couple of years that basically went down 90%. It's small. It's not a huge amount of money, but it's actually starting to come back. It's kind of.
Well, I hope you have some FTX tokens because they just went vertical like a meme stock.
I don't. What do you think about the sentiment significance of SBF getting convicted, getting sentenced?
What struck me about the trial and the sort of the reaction to the trial is the absence of outrage. There
was a lot more outrage with Madoff.
There was a lot more outrage with Madoff.
Yeah.
And I mean, you have tens of billions of dollars that were lost, and no one is screaming. And the same is true with WeWork, the same was true with Theranos. I mean, I've never seen people lose so much money and shrug it off. And that to me is a real sentiment indicator that people who are managing money, investors in their portfolios, have made so much money elsewhere, or believe that the pipeline of future money to be made is so great that they're able to look at this and go, okay, I lost on one. It's like, you've lost on about 50. You know, I don't know when the tipping point comes.
You know where else I've seen that attitude is in ESG. Because I said this at the time. I don't remember where I wrote it, but I was like, we got so rich as a society that in our investment activities we said we care less about making money than we do about doing good. Which, like, I'm like, we are so rich.
Yeah.
Like, we are so fabulously wealthy that we actually have the luxury to say we don't care about making money. Like, it's incidental to what we're trying to do here.
Yeah, ESG to me was a huge sentiment indicator in plain sight that confidence was extreme because there was this incredible sense of abundance.
Yep.
That, you know, we are now at a point not only where we can invest and not worry about returns, but also we're going to tackle these highly abstract goals of climate change and nobody blinking. And those are the kinds of things that sort of go to the moon mindset that you only see at peaks in confidence, and the fact that it happened to coincide with all the SpaceX and, you know, space tourism. It was just, you know, checking another box of how extreme confidence had become.
So let's talk about confidence and let's talk about the stock market.
Yeah.
The S&P is trading around 4,400. You know, I'm a sentiment guy. I don't spend a lot of time looking at valuation, but it's expensive. Still, like, in spite of rates going a lot higher, in spite of the economy getting weaker, like, stocks are sort of abnormally strong. I think people are expecting 12% earnings growth. I don't see how that's going to happen. One of my experience in markets is that the stock market is usually the asset class that is last to know about a recession.
Mm-hmm.
Like, if you go back to 2007, right? Like, home builders crapped out at the end of 2005. The subprime mortgage lenders crapped out in 2006, the ABX, and the stock market made a new high in the summer of 2007, and nobody could believe it, you know, and yet it did anyway. And this feels very similar to me.
Yeah, and what's driving valuation is the Magnificent Seven. And what I find striking about that is, if we go back to 2021, the kinds of things that investors were pouring money into, you know, SPACs and NFTs, was this pure fantasy. And in this rebound since last October, they're betting on the sure thing. Microsoft, Apple, the biggest of the big. And I just think that that's an underappreciated change in mood. We're speculating in the certain to succeed companies, not these fantasy dreams.
Yep.
And I think it speaks to a level of conservatism that's already in the market that people underappreciate.
Well, I think that, I mean, nothing goes on forever.
Nope.
The Magnificent Seven won't be the Magnificent Seven
They'll
forever.
become the Maleficent Seven.
Yeah. So that's going to happen at some point. I've seen a lot of chatter about the underperformance of small caps versus large caps. I think it's getting to extreme levels. I'm starting to wonder, I mean, small caps have basically underperformed large caps since 2003. It's been 20 years. And there's a whole bunch of reasons why that has happened, political reasons and all that stuff. But just the volume of people talking about it kind of leads me to believe that we could be close to a turning point in small caps.
Well, and that would be consistent with your view. If rates are now coming back down, small caps should be the real beneficiary of that, because of the association people make between high interest rates and indebtedness of small cap companies, relative indebtedness.
Yeah, I think if you took IJS, which is the iShares Small Cap Value ETF, and if you took IVW, which is Large Cap Growth, and you bought IGS and shorted IVW and you put it away for 10 years, I think you would be pretty happy if you just didn't look at it.
Yep.
I think that would probably work. So, but I remember, it's funny because, I was much younger, but in the dot-com bust, that was really the last time that small cap outperformed. And it was small cap value. It was that part of the style box. And I happened to have a small cap value fund. I mean, I didn't have much money at the time. I probably had like $6,000 in it or something like that. But it was making it made like 30 or 40% a year for like 3 years.
Yep.
So some of these style box trades can really work if you get them right.
Well, and it speaks to being diversified by sentiment, which is something I harp on a lot.
Well, talk about that.
So I think correlations are a function of mood. If stocks and bonds are moving in lockstep, so's the mood of holders of those instruments. And I think since 2021, we've had stocks and bond mood really aligned. As one has dropped, the other has dropped with it. And the dollar or non-dollar currencies being part of that trade as well. And I think investors, 60-40 investors, have been bludgeoned by it. And they didn't appreciate that going into 2021, you had negative interest rates, you had wild speculation and crazy stocks, and they missed that you had manias in both debt and equity at the same time, which the 60-40 portfolio doesn't believe is a possibility. And I think that investors should be thinking about, if you're going to own the Magnificent Seven, what should you be buying that people are, repulsed by? And I think investors would be wise to consider the things that are laughable in their portfolio.
The trades that would get you kicked off the set of CNBC.
Yeah.
Laughed off the set.
Laughed off the set, or the things that would be said about you on Twitter.
So what is that right now?
Right now, I think some of it is
maybe bonds.
I think some of it is long bonds. I think some of it has been, I would put things like natural gas in it, corn. There's some interesting commodity trades now that are being laughed at just because they haven't responded the way people expected them to, given geopolitical strife.
I will also say that, even though oil has sold off a lot, the sentiment is still very one-sided on oil.
I agree.
Still very bullish.
Yeah. But you hear no one talking about natural gas, certainly in comparison to the way they were speaking of it when you had the events in the Ukraine last summer.
Well, you remember at the time when natural gas spiked, I was tweeting, "We are not going to be talking about this in a month."
and there we are. Yeah, and it's almost like clockwork. Yeah,
Yeah.
and particularly in the commodity space, it's interesting to me. I always take
Orange juice.
Yeah, lumber. People focus on these odd commodities moments before sentiment turns in them.
Yeah.
And so I always take note when there's a hot commodity trade. Olive oil was another one earlier this year. It's like, okay, but because they tend to reach popularity.
When they make it into the mainstream news, then the trade is over.
Yeah, and I feel the same way often with certain foreign markets.
It's funny. This was a couple of months ago. I was having dinner with my wife, and we were watching NBC News, and they, for like 2 weeks in a row, they did nothing but talk about insurance in Florida, like homeowners insurance in Florida. I just turned to my wife. I'm like, this is not going to be a problem in a year. Like, prices are going to get high enough. Insurance companies are going to come back in. Supply is going to meet demand. Like, prices will come down. Sure enough, you haven't heard anything about it in a couple of months.
But you've seen great results from Berkshire Hathaway.
Yep.
So yeah, that the industry is repriced.
Yep.
Let's go back to housing for a
Sure.
second. The home builders have been largely immune from the rise in rates. If I look at their stock prices,
Yep.
So what happens in housing? Does supply, what happens between the imbalance in the rental market today versus the housing market? I mean, the cost of ownership is 1.5 times, almost 2 times the cost of renting.
Yeah, I mean, the cost of ownership is usually higher than renting about 90% of the time.
Yeah,
There's about 10%.
But I
of
mean,
time
the
it's
gap
renting.
between the two
Yeah,
has reached an extreme.
It's funny. So Myrtle Beach is kind of an interesting test case for that because there's thousands of houses going up. I mean, the building is just insane. And I'm friends with a couple of real estate appraisers, and I was driving around with them last weekend, and we pulled into a Lennar development, and these are small houses. They're like 1,400 square foot houses. Like, they're small. They're not nice. They're just not nice houses. Like, they're just cookie cutter neighborhoods and stuff like that. And I said to the appraisers, I was like, how much do these houses go for? And they said, about $290. And I said to them, I was like, 5 years ago, these would have been $120,000. And they said, absolutely, that's about what they cost 5 years ago. And now they're $290. And you think about, like, at 7% interest rates on a $250,000 mortgage, it's probably about $2,000 a month. $24,000 a year, and if you're on an income of $60,000 a year, like, that's a lot.
Yeah.
Yeah,
I have two 20-some children, and they live outside of Washington D.C. and there's no way they can realistically look at buying a starter home there.
Yeah. I just when I see what's going on in Myrtle Beach, I said to myself, I'm like, home building is the most cyclical industry in the country. It's so cyclical. Like, for a period of like 4 or 5 years, it's like, let's build as many houses as we can, and then for like 4 or 5 years, it's like complete depression, like nobody's building anything, and then it's it's just like hugely cyclical.
Yeah, and it strikes me that something's got to give in housing here. Either we see unexpected wage inflation, or we see price deflation, or some combination of the two.
Well, it's probably going to be price deflation. I imagine. I'm not a housing analyst or a housing expert. I've seen the chart of new home construction, over the last 20 years or whatever, and it's pretty much gone parabolic.
Yep.
I do know that we were vastly underbuilding throughout the 2010s. I mean, we were clearly undersupplied.
Yeah.
But at some point, we're going to reach equilibrium and go beyond equilibrium, and prices will come down.
Come down with that.
Yep.
Foreign markets. If we look at the objective data, the rest of the world is cheap compared to the US. And yet, no one is excited about it.
Well, so I have some thoughts about that. In my portfolio, I have a very cool ETF. The ticker is DTH. It's a wisdom tree ETF. It's like a high yielding European equity ETF. I mean, the yields are just incredible. You're talking about like 8 to 10%. I've said this before, like, I think as an investor, you kind of want to buy the single digit Ps and the high dividend yields. Like, you don't want to buy 30 Ps and no dividend yields.
Yep.
Like, that's like just objectively. And yes, like Europe doesn't grow. Like, so if you care about growth, you come to the US, but at some point people might care about something other than growth. They might care about valuation. They might care about safety. They might care about having a margin of safety. India is kind of the exception to all this. It's starting to break out after forming like this really like big long 10-year base. And Modi's done a lot for the country. And it's actually like India's small caps are starting to get kind of bubbly. But I think it could be, I think it's the beginning of that trade. I think that could actually have a ways to run, especially when you consider that, all the other big emerging markets are more or less uninvestable. I mean, China, Russia doesn't even have a stock market anymore. Brazil is a disaster. Like, all the flows are going to go into India.
Yeah, and you've seen sort of this this crowd move in association from China to India.
Yep.
Whether it's policymakers, business leaders, everyone's touting their new India connections.
Yep.
So it's clearly a much more attractive in terms of socially being involved than China has been.
Yeah.
So I want to circle back, 'cause you said something about energy and that the absence of that, even with this price sell-off, enthusiasm is still high. I wonder if a year from now we will look at the deals that ExxonMobil and Chevron did as being peak sentiment trades. Those mega mergers that happen only when confidence is extremely high.
The AOL Time Warner type of deals. Yeah.
But these being in an industry that's already highly concentrated, you had Hess, you've got
Pioneer.
So it just feels very similar to what we saw in the bank sphere, when B of A and Nations merged and Bank One and for Chicago merged, this coming together of the big firms at a moment in time, and then it gets very quiet thereafter.
Well, I think oil's going to 50.
I wouldn't be surprised.
Yeah.
Consistent with that would be the attitude, the sentiment of the Saudi royal family. I mean, if you look at the way the private investment fund and the government more broadly has been investing in sports, in NEOM, this multi-mile long city of the future, that's indicative of a euphoria in oil prices that is likely to be deeply humbled in the future.
Yeah, they're not immune to it. They're not immune to it.
And you could put the Israel-Saudi peace treaty in the mix of that too, because all coming together at this same time.
Yeah. The thing with oil for me really is about the economy, and oil has gone from 95 to 75 in like 3 weeks. And it peaked at basically October 7th.
Yeah.
But I think the energy markets are discounting a recession. I think that's what's going on. And if you go back to July of 2008, Oil was at 140, and it went within a couple of months. It was trading at 30. Like it was all demand destruction. And you probably read this in my newsletters, but when you look at oil, everybody's focused on the supply side. Like, you can calculate supply. You know exactly how much supply we have, but you cannot predict or calculate when demand evaporates. And it doesn't, at the margins, it doesn't take much to cause the price of oil to come down a lot. I mean, we're talking about maybe a 2 or 3% decline in consumption, and it goes down like $20.
I don't mean to introduce politics into the discussion, and I would say this whether the current administration was Democrat or Republican, but Bidenomics, the sudden touting of Bidenomics that we saw earlier this summer, feels like
peak. One
of those things that a administration only touts moments before an economy turns down. And again, I would say the same if it was a Republican administration as the current Democrat one. But policymakers follow mood, and you're promoting what's working, and when you start to promote the economy, it's like that's a sign.
Yeah, and unemployment is already up 4 clicks since then. So
we'll see what happens.
Yeah.
It's been great to talk to you and to catch up and to finally meet you in person. We talk a lot on social media, and I read what you write, but it's been very fun.
How's the book going?
The book is good.
Yeah.
So I wrote this book, The Confidence Map, and what's been interesting is that I wrote it for business leaders, investors, and I'm finding that investors are reading it in their job, but also in their life. That it's resonating in terms of navigating things outside of the markets. And that's been really rewarding to see that kind of interest in the book from a wellness perspective.
Cool.
Cool. And you have a new book that you're...
Yeah, coming out in January.
Yeah.
Yep.
Congratulations.
No worries. How to live a stress-free financial life. So.
Awesome.
Yeah.
Congratulations.
Thanks. All right. Thanks for speaking on The Collective.
I really enjoyed it.
Good to meet you.
Thank you. Likewise. Thanks.